So after we had a very strong stock market rally in January, the first 2 weeks of February have been bearish. They have ended the first 2 weeks of February down in the stock market. And more people are now saying that, you know what, this bull market is over. Or in fact, most people are saying it's not even a bull market. It was a bear market rally and now it's over because inflation is beginning to flare up again. That we thought inflation is coming down, but no, inflation is getting hot again. So how true is this? Is inflation really getting hot again? And is this the end of the bull market? Let's take a closer look at the charts and at the macro fundamental data. I always find it very entertaining when people ask me, Adam, the market went down yesterday. Is the bull market over? Is it now a bear market again? Or the market went down for the last 1 week and 2 weeks. Is the uptrend broken? Are we now on a downtrend? Remember that one down day does not change a trend, does not a trend change. One down week does not change a trend. So for those of you who are not familiar with how trends work or not familiar with technical analysis, here's a quick lesson. So first you got to understand, when you ask this question, is the market on an uptrend or a downtrend? It depends on your time frame. We have got the short-term time frame, the medium-term time frame, and the long-term time frame. So first of all, on the short-term time frame, are we on an uptrend or downtrend? The answer, on an uptrend. How do you know? Let me show you a very simple way to tell. All you got to do is to take a look at the 20 and 40 exponential moving average. This red line here and this blue line here, that's the 20 and 40 EMA. So really simple, just remember, as long as the 20 EMA is above the 40 EMA, it's a short-term uptrend. Okay, so right now 20 above 40, short-term uptrend. And you can also tell by the price action. Take a look at this. Wave up, wave down, wave up, wave down, wave up. And now we're going on a wave down, but still on that short-term uptrend. Remember, an uptrend is defined as higher highs and higher lows. So this is a high, that's a higher high, that's a higher high. That's a low, that's a higher low, that's a higher low. And right now we are going through this retracement and we're going to make a low, somewhere here or somewhere here, wherever, right? We can't predict the exact low, but as long as this low is higher than the previous low, it's still an uptrend, right? It's still an uptrend. Probability is that, whoa, we're going to continue going higher. Once this trend has finished, or once this retracement has finished retracing. So short term, we are on an uptrend. Okay, now how about medium term? Medium term, you look at the 50 and 150 moving average, which is this blue thick line and this green thick line. So just remember, very simple, when the blue thick line is above the green thick line, that's a medium-term uptrend. So right now, are we on a medium-term uptrend? Still are. 50, still above 150. So medium-term trend is still up. All right. Finally, are we on a long-term uptrend? Not yet. The long-term trend is not up yet. The long-term trend is still down by definition because the long-term trend is measured by the 200 moving average, which is this red line. So again, what's the rule? Really simple. When the price is above the 200 moving average and the 200 is sloping up, that's a long-term uptrend. We're not there yet. You can see that the price is above the 200, but the 200 has not yet sloped up. It is still, well, it has now flattened. So it's kind of like in the transition of going into a long-term uptrend once the 200 slopes up. Again, we're not there yet. We should be there in the next few days, right? If the next week the market goes up, we can confirm it's a long-term uptrend. It's going to last long-term, right? Now you can see over here, this was a long-term downtrend because the price was below the 200 sloping down, but now 200 again is beginning to flatten. So now you understand how to read trends? Okay, great. So again, we are still on a short-term uptrend, a medium-term uptrend, but long-term trend has not yet confirmed. Now, so the next question is, okay, we are on a short-term uptrend, all right? Again, wave up, wave down, wave up, wave down, wave up, all right? So it can't go up in a straight line on an uptrend. It's got to wave down before it can go through the next wave up. So the question right now is that we are now going through this wave down, right? Going through this wave down. So $1,000,000 question is, how low will this wave down go before it finds a bottom and continues going up? Now, again, no one can predict for certain. No one knows 100% where's the bottom of this retracement, but we can guess. We can guess by looking at support levels, trend lines, and Fibonacci. So let's look at some possibilities where we could see the end of this current pullback on the short-term uptrend. So the first thing is to take a look at trend lines. Do we see a trend line anywhere? All right. Well, let's take a look. If we take our trend line tool over here, and let's click from the start of this, and we kind of like measure there, over there. Okay, so this is a possible trend line, right? There's a low, there's a low. So, and this trend line coincides with the 50 moving average, the blue line. So this could be a strong level of support. So don't be surprised that we could go down a bit more to test this support before the next wave up pattern. Now, it doesn't mean that it has to go there, but there's a possible level of support, right? Now, what's interesting is you can also draw multiple trend lines. So if you look at this, you could also argue that, hey, could this also be a trend line here where, I click on this, and voila, could this be a trend line? Yeah, this could also be a potential trend line because this is a low over here, that's a low over here, and we just tested this over here. Okay, so that's one trend line, that's another trend line. Now, you can also use Fibonacci to kind of like guess where it's going to go. So those of you who understand Fibonacci, basically you know that it's always an A to B wave up pattern and a B to C wave down pattern, and then the pattern continues, right? So after an A to B pattern, B to C would be a retracement of either 38.2%, which is a shallow retracement, a 50% retracement, which is a medium retracement, or a 61.8% retracement, which is a deeper retracement. If it goes below 61.8, usually the trend is over. Not always, but oftentimes. So let's take a look. Where's the 38.2% and where's the 50% and even 61.8% retracement level? So with that, let's go to our Fibonacci tool. Click on Fibonacci, all right? And we begin by, okay, where's the start of this wave up, right? This wave up started somewhere, let's see, well, you could argue started here. So click this A, drag to B. There we go, all right? So where's our 38.2%? There, that's our 38.2% level. So we have a Fibonacci support right here, right? Which again coincides with this area, right? Then our 50% retracement coincides with the 50 moving average, which also coincides with this trend line. Pretty magical, right? It's kind of like a line. And the 61.8%, which is the deeper retracement, coincides with the 50 and 200 moving average right here. There we go. So from here, we can conclude that based on the charts, there are 3 levels of support that could serve as the bottom of this retracement, right? So the first level of support would be here. Let me draw a line here. Boom, there we are at 401. Second level at 396, and third level at 391. Okay, so there we go. So let's watch the market next week and let's see what happens. So again, there are 3 possibilities, right? The first possibility is that this is the end of the retracement. Very, very shallow retracement. It hits about somewhere here, 38.2, and then continues up. Or if it's a medium-term retracement, it may hit this level here at 396 and then goes up. Or the deeper retracement is it goes all the way to this here, which is again the 200 moving average plus the 150 plus the 61.8% Fibonacci level. Very strong support, and then goes up here. Again, no one can predict where the bottom is until it shows itself. Or again, if you're trading the market, you don't buy once it hits a level, right? You wait for a bullish candlestick pattern, like a bullish pin bar, or you wait for a double bottom with a bullish engulfing pattern. You gotta wait for the candlestick pattern to confirm the bottom before you go long if you're taking a swing trade. And of course, if it's a swing trade, place a stop loss, all right? And of course, you can use some momentum indicators to confirm it, like look at stochastics, Williams percentage R, make sure it's oversold, or look at MACD. You know, there are many things you can put into your swing trading strategy. Now, but if you are investing for the long term and not trading, then there's no stop loss, you don't need a candlestick pattern, right? Once it hits a level, you could just add some shares. Dollar cost averaging, hits the next level, add some more shares, hits the next level, add some more shares. So you kind of like average in slowly, not blindly, but using these levels of Fibonacci and support levels to enter at more optimal price points, okay? So that's what we can see on the charts. Now, again, some people would ask, but hey, Adam, could this actually be just a bear market rally? That this is just going to break all the support levels and is going to make a new low in the market, even lower than last year, and we go even lower. Is that possible? In fact, the majority of fund managers actually believe that's going to happen. That's right. A recent survey that was carried out in February of this year showed that out of the survey of all the global fund managers, you can see that over 65% believe that this is just a bear market rally and we're going to go a lot lower this year. And only 20% of global fund managers and me believe that it's a new bull market. So again, the majority of people are still very, very bearish and pessimistic. And the reason behind their bearishness is because they believe that inflation is not over. It's kind of like the horror movie where you thought that killer was dead, but when you turn around, he comes back and he stabs you from behind. And they believe that the Fed will have no choice but to keep raising interest rates even higher than expected to force the economy into a recession. And that's what most people believe will have to happen. That's inevitable, like what Thanos said, right? But is it really true? Well, again, no one knows. And of course, anything can happen in the markets. Anything can happen to the economy. No one can predict for certain. But let's take a look at some facts, because last week, we had the CPI report that came in higher than expected, and the PPI report that came in higher than expected. That freaked out a lot of people and gave a lot of fuel to the bears and say, see, we told you that inflation is not over yet, it's coming back, it's going to kill all of us, we're going to die, right? So let's take a look at the numbers and let's see, is it as bad as they make it out to be? So the first data that came out was on the 14th of February, where the CPI, Consumer Price Index, which is one way to measure inflation, came in higher than expected. So you can see CPI climbed 0.5% in January, which was the most in 3 months. And the annual headline CPI and core CPI came in higher than expected. So over here, you can see that and year on year, CPI was up 6.4% from 1 year ago, all right? So again, let's take a look at the numbers. So you can see that month on month, there we are. The last CPI report showed that core CPI came in at 0.52%, which was the highest in 1, 2, 3 months. So people freaked out, oh my God, it's going up again, right? And it was much higher than expected. Core CPI was 0.41%. But if you look at it on a year-to-year basis, again, CPI came in at 6.41%, right? And core CPI came in at 5.58%. So in other words, if you take a look at the year-on-year increase, it's still declining year-on-year, but less fast than what people expected. So if you take a look at the change in CPI year-on-year, you can see that it's still going, well, it's flat, right, in the last month, but it's still below, it kind of like peaked in June of last year, and it looks like it's still on this downtrend. Now, core CPI, which is what the Fed looks at more, you can see that that came down. Again, it peaked somewhere in September. So that was a CPI report. And then we had the retail sales report that came in stronger than expected, that the US retail sales jumped the most in nearly 2 years, that people were surprised that January retail sales was a lot higher than expected. So on one hand, you could say, wow, that could fuel inflation. But on the other hand, it also says that the consumer spending is still very strong and the economy is still very, very strong. This came in on the 15th of February. Then on the 16th of February, which was on Friday, that was what people blame for the sell-off in the markets, that the PPI, the Producer Price Index, the wholesale prices rose more than expected, right? It rose 0.7% in January, more than expected. Again, fueling this fear that, oh, inflation is coming back again, right? But again, let's look at the numbers. How bad is it? So the PPI rose 0.7% for the month, and it's above expectation, which was 0.4%, right? And but on a 12-month basis, again, year on year, PPI increased 6%, which is still elevated, but it's well off its 11.6% peak in March of 2022. So let's take a look at the charts and let's see what it looks like. So again, January PPI came in at 6%. There we are, 6%, right? Versus 5.4% expected. So again, it was higher than expected, all right? But it was lower than 6.5%, which was the prior month, year to year, right? Core CPI came in at 5.4%, again, higher than the 4.9% expected, but lower than the 5.8% prior. So again, if you look at year-on-year inflation of PPI, you can see that it's still on a downtrend. Again, it's going down. It's not it's going up, it's going down, but not going down as fast as expected. Now remember that there are always two sides to every coin. So for all the bearish data that you can see in the market, there's also a lot of bullish data. So what's important is not to be biased and only look at the bearish data or only look at the bullish data. Look at both sets of data and kind of like balance it and say, at the end of the day, am I more bullish or more bearish? And it's completely up to you. It's your decision that you got to make. So personally for me, I'm still more bullish and bearish because of the technical price action and the fact that I think that there's still a lot of very strong bullish economic data. That yes, inflation is not going down as fast as we expect, but at the same time, the economy is bloody strong. The economic data is coming in stronger than most people expect. So for example, you can see the jobs report back on the 3rd of February showed that the number of jobs created in the US came in at 517,000, which was way above the 187,000 estimate. So can you imagine the number of jobs being created is like more than double of what economists expect, and unemployment has hit a 53-year low. And again, it's a bit hard to go into a recession when you got 500,000 jobs a month, right? And you got a multi-year low unemployment rate. So you can see over here, monthly job creation, suddenly spiked in January. And although wages are still increasing, but wages increase have been decelerating, which is good for inflation, which means that inflation could get some respite, right, from that. Now, if you look at the real-time GDP tracking data from the Atlanta Fed, you can see as of 16 February, the estimate for GDP 2023 Q1 is currently at 2.5%. All right, so again, nowhere near recessionary levels. And what's interesting is, again, recall last year, the majority of economists, almost every mother, father, son said recession was inevitable in Europe. And now Europe, no recession. They say, there's going to be a recession in the US, is inevitable. But now a lot of them are now changing their tune, right? Goldman Sachs just said we're cutting our US recession odds to 25%. Only 25% chance of a recession, down from much higher last year. And now the IMF, International Monetary Fund, they say there's a turning point for world economy as growth bottoms, which means to say that they think that the global economy is now going to not go into recession, which they thought would happen last year. So in other words, recession fears have actually peaked and are coming down. you can see that again, November last year, percentage of people saying there'll be a recession was 80%. And since then, it has come down. It peaked and came down. Now, when was the last time recession fears were so high? It was April 2020. It peaked and came down. And March 2009, it peaked and came down. And what's interesting, if you look at history, is that this peak coincided with the bottom of the market here. This peak coincided with the bottom of the market here. So could this peak coincide with the bottom of the market here? I believe so, right? And that's why I remain in the camp that we are in a new bull market, right? Now again, at the end of the day, could I be wrong? Of course. I'm not all seeing, I'm not all knowing. Anything can happen in the markets. And that's why it's really important that if you are trading, you always have a stop loss, so that if the market turns the other way, you cut loss fast and you only risk a small percentage of your capital, right? And then be prepared to take a new trade when you see a new uptrend pattern or go short on a new downtrend pattern. And if you are investing, remember to only invest with money that you don't need in the short term, and always invest with a long-term view and to slowly average into the markets. Now, here's the thing. It's kind of like Lord of the Rings. Remember Golem or Smeagol here, this dual personality. Yes, Master, no, Master, I want to kill him now. So I find that as an investor, I have got kind of like two parts to me. All right. So on one hand, I'm happy for people when it's a bull market, because, people generally in the bull market, they feel more confident. So on one hand, it's like, I want to be right that it's a bull market, right? But there's a part of me that hopes it's not a bull market, right? I have to admit to you that there's a part of me that hopes that it's going to go down again. Because remember that as an investor, my goal is to, buy high quality companies at the biggest discounts. That these companies will always go up in the long run, but in the short term, the lower they go, the more chance I have to average in my positions. And I'm here to tell you that, for example, this year, I've set aside a certain amount of money to put into the markets. And I can share with you right now some of the stocks that I really want to add more shares to are Apple. I want to buy more Apple. I want to buy more Nvidia. I want to buy more United Health, more Thermo Fisher, buy more Lowe's, for example, right? But the trouble is that I've not been buying. I've not been buying anything so far this year. Why? Because it's not gone low enough. Remember, as an investor, I only buy when it's undervalued, when it's below my intrinsic value, and I buy when it hits my support levels, and I average in 3 to 4 tranches. So let me give you an example. So let's look at Apple, for example. Now, I already have shares in Apple, but I want to buy more shares. And where would I buy more shares? So let me show you how I kind of like put these lines on my chart. So for example, Apple, the intrinsic value of Apple is $150. This is based on my own valuation, right? So I only want to buy if the price is below 150 by a certain amount, because I want a margin of safety. So you can see I've drawn 4 support levels here, which is 143, 134, 124 and 113. So in other words, I will only buy if Apple goes to 143. I'll buy, let's say for example, this year I want to put in another $10,000 into Apple, let's say, right? So only when it hits 143 would I buy a quarter of my allocation, which I'll invest $2,005 in Apple. Then if Apple goes to 134, I'll put in another $2,005. If it goes to 124, another 2005. And finally, only when it hits 113, which is the last support level, would I go into my last tranche. So I fully deploy my 10,000 in Apple. All right. So in a way, I'm pretty upset because it's not coming down enough, right? So you can see that. Now, if you look at this purple line here, 130, that's my current average cost of Apple that I bought last year. So I want to buy more than what I bought last year. All right, so you can see that I'm actually waiting for it to retrace to 143, going to buy a bit, retrace here, buy a bit more, and whatever, right? So if it keeps going up, I won't have the chance to buy any more Apple this year, which would really piss me off. So like I said, I've got this internal conflict here that I want it to go down first, okay, before going higher later on, right? So if you're wondering how I draw these support levels, it's all based on moving averages. For example, if you take a look at the long-term moving average on the monthly candles, you can see a very strong support at the 50 moving average on monthly candles. And that's why 113 is exactly at the blue line, which is the very strong support where I would load the freaking truck on Apple. All right, but would it get there? I don't know. I can't predict that. I hope, but it may not, right? But just be patient. And as an investor, only buy when the price comes to you. The next one that I really want to add more is NVIDIA, okay? So NVIDIA, you can see, for example, my average price, my average cost of my current shares is 150. Right now it's at 213, and it's a bit overvalued right now. So my intrinsic value of NVIDIA is 201, as you can see. So it's above my intrinsic value, so I can't add more right now because it's not cheap anymore. But where are my levels to add? As you can see, my levels to add would be first support level 192, 167, 142, and 114 would be the last level to add. So in case you're wondering, this is exactly what I do with my subscribers. Those of you who subscribe to my UIP, the Ultimate Investors Playbook, what I do is every month I do a deep dive research into companies. You get live alerts whenever I'm buying, live alerts when I'm selling, and I do all this intrinsic value calculation, and I share all my valuations with my subscribers, and I also share my updated support levels every month. So you know exactly what I'm buying, when I'm selling, and how many shares I'm buying, right? So just to give you an example of Apple and NVIDIA on where I would add shares. So you can see right now they are both not addable because they are not cheap anymore. So hopefully if the market retraces a bit more in the next few days, I could build a bigger position before it goes back to the moon, right? So I hope you enjoyed this video. May the markets be with you, and I'll see you guys in the next video. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.